Hello, everyone, and welcome to another episode of our show, It's All in Your Hands. I'm excited to introduce you to Ken Gee, a fantastic person I got to know through Grant Cardone Real Estate Club. A few years ago, when I wanted to learn more about real estate and I was looking for pros in this industry, then I came across and I was introduced to Ken. And he is not just a valuable member of the group, but also a mentor and important partner. I even invested with him in his funds, and it's been a rewarding journey. So here we go. Ken brings a wealth of experience, especially from working with Grant Cardone. And today we're going to dive into the secrets of investments, wealth creation, and the private equity, and making that extra income. Help me to welcome Ken. Thank you so much for being here with us.
Well, thank you for having me, and your remarks were way too generous, but thank you very much. Thrilled to be here.
Yes, and thank you for being here. I know your time is very valuable. So before we're going to start discussion, Ken, can you just share a little bit about your experience and your background? And I understand you used to be a CPA, and that was quite a unique starting point for you.
It was, yeah. So quickly, I grew up in Toledo, Ohio. Nobody ever has heard of that unless you watched MASH. The old show, Max Klinger, he was from Toledo, so that might be the only way you might know Toledo, Ohio. Got my undergrad from the University of Toledo, then I moved to Cleveland, where I became a commercial lender. Spent 5 years doing that while I pursued my graduate degree at a small private school called Case Western Reserve. And that trained me to be a CPA. So then I left the bank after 5 years, went to Deloitte and as a CPA, and spent 7 years there in the tax side of the business, doing all kinds of really fun stuff, if you can call CPA work fun, but I did lots of transaction planning, merger and acquisition work. I had a lot of private equity clients and just a lot of the fun side of tax, again, if you can call it that, but it's the tax planning rather than just the tax compliance. But it was then that it really got me into real estate. Many of you have probably heard. My kids were very, very young. My daughter was just born then, and I used to do her 3 a.m. feeding because mom needed a break, and it was the only time I got to be home long enough to see her. So I used to do that 3 a.m. feeding. It was awesome father-daughter time. The problem was after a few weeks of doing that, I started to think to myself, wait a minute. I did everything I was supposed to do. I went to school, got good grades, got a great job. I thought I'm set. But wait, this is the best I can do for quality time with my daughter. And that made me want to really change my life. And so that's when I started getting into real estate. I ended up, back then, there wasn't, podcasts like this or any courses or programs or anything like that to learn the business. So it was really hard. I had to go to apartment association meetings, try to figure it out. But what I was able to do was over a period of 3 years, buy and sell three, just small apartment buildings, like 24, 28 units, and made $500,000.
Wow.
And I was like, wow, wait a minute, man. I just made more money on the side than I did the whole time I was at Deloitte up until that point. I said, you know what? This is something I got to do because now I can find a way to actually take control of my life, not have to answer to someone else all the time, and actually get to spend time with my kids. And fast forward now 25 years, and dozens of deals later, and thousands of units. I accomplished my goal. I got to see all my kids' stuff. I got to go to all her basketball games, all my son's baseball games, and still got to make a good living. So I'm proud to say that that leap of faith that I took back then really paid off.
Wow, what a fascinating story. Thank you so much for sharing. And I love how you said you just live of faith and working, having that security. And I think, that's what every person wants to have, that security, and like so afraid of taking this first step. But I love how you said that you wanted to take control of your life. And
Yeah, that's what it was really about. Yeah, yeah.
yeah, wow, that's amazing. That's amazing. And so, and the real estate that so you purchased, so you were still working while you purchased these properties on which you made profits.
Yeah, yeah, and that's the cool thing about real estate is you don't have to quit your day job and then go into real estate. You can kind of do this on the side. And that's what I did. I mean, I was still working at Deloitte at the time, still working 70, 80 hours a week. And I was able to pick up a couple small apartment buildings. And then after you make $500,000, you start to realize, wait a minute, I, why am I focused on this when I should be focused on what can really change my life? And that's, slowly as we went on, I then did quit my job at Deloitte. And I think it was '01. Yeah, 2001, I quit my job at Deloitte and have not worked for anybody since but myself.
Wow.
Well, and now we have our company, so of
Yes.
course.
Yeah, you have your own company and you have your own funds. Yes. Wow, that's amazing. Well, listen, I can completely totally resonate with you because, I am in the tax field myself, but I kind of got stuck a little bit here for I've been doing this for over 26 years. I wish I would actually known you before and I would have all of this realization that, just having that business and doing this taxation, that's not something that is going to make all this money and make us rich. And one of the things and that's kind of what caught my interest in the real estate, and you've been my mentor and Grant, and you taught us actually how you can start making money and have that extra cash flow, have passive income. So if you can share a little bit more about that. I hear this very often from my clients, from friends, relatives, is the people a little bit skeptical. People skeptical about believing that, there is no such a thing as sleeping and making money. Like you have to work hard for it. You have to have your secure job, or if you have a secure business. So there's like, what are your thoughts on the investments?
Yeah, so there's two ways to approach real estate. One is as a passive investor, and you had said that you invest in some of our funds. So if you're in our fund and you just wrote us a check, that's passive, right? So that is easy. That is real money when you sleep, right? I know they always find little catchphrases to try to get people to remember what we do. But when you think about what I do so that you can invest in the fund, it is a lot of work when you're in our chair, when you're us. Apartments are businesses, no different than your business, anybody else's business. We have to get to know the nitty-gritty details of the business. We have to make sure we solve human resource problems, vendor problems, maintenance problems. I mean, you name it, legal problems. We have all the same problems that any other business has. So it is a lot of work. The really big difference for me is a couple of things. One, that now I get to build something for myself, right? I'm not building something for somebody else. So that makes me feel good. Now, what has happened to me over the last 3 to 5 years is actually, I did not expect this to happen. And that is that, you never understand what you're all about if you don't take the time to look back and say, okay, what have I done? Where have I come from? How have I done what I've done? Well, I've done that over the last 3 to 5 years. And what I've realized is now I've been doing this for a long time. Early on in my career, there are a few people that helped me, guided me, mentored me. And now, fast forward, 25 years plus that we've been in business, I actually have that ability to do that for others. And it's interesting that as you age, early on it was about me, money, money, money. I needed it, right? I had a young family, and I had to make sure that I was able to provide for them. Not that we don't still make money. We certainly do. But now I get to have that whole side of me that enjoys helping people make the same difference that I did, or same changes I did 25 years ago, because it truly is life changing. But it's like anything else. You've got to learn it. You've got to understand it. You got to do it the right way. So we now have developed an entire side of our business. It's our investor education program that gets people headed in the right direction. If they want to do what we do,
Yes.
and start off doing it, that we can teach them how to do that. So now, I call it, if you want us to do it for you, you can invest in our funds. If you want to learn how to do it, we can help you do that, right? Because we can teach you. And if you want to do it with us, well, there's no reason why we can't be a partner if it's a good match. So now we're really able to help people create insane amounts of wealth in real estate through whatever fits for them. And that makes me really happy because that last part of it is really developed over the last 5 years. And I'll tell you, it's really cool to watch someone go from not knowing how they're going to figure this out to actually doing their first deal, there's nothing more rewarding than that. I'm here to tell you.
Yeah, I mean, I can imagine. Yes, absolutely. It's being able to build your own business, your own life, your dream life, and then at the same time, it's being able to give to others. Just like you mentioned, listen, you can do it with them, and you can do it for them, right? Or so, and that's kind of this is kind of what I do. This is my partnership with Ken, is that I just invest into his fund. So like, I don't have to do anything. I don't have to deal with the tenants. I don't have to deal with all the problems that the tenants experience. So Ken and his team, they take care of everything, and the only thing that I need to do is just get my checks, and that's it, and spend the money.
Make more money. Yep.
Yeah. So that's the beauty of it, right? So you can, and this is the beauty of the passive income, is you have the choice of, yes, you can sleep, you can enjoy your life, and then you can just earn these earnings and do whatever it is that you want with them. Or at the same time, as Kengi does, is that he can even teach you, and I'm actually part of your program as well. Yes, so that's amazing. That's beautiful. So yeah, so then I guess then to the point is, to those that don't believe that there is such a thing as this passive income where you can just earn money while you're sleeping, it depends on which path do you choose. If you choose just to be as a passive investor where you just give the money and don't do anything, then you receive the rewards. Or then if you choose to be working for it and being involved, then that's obviously becomes as a business and as a full-time job for those. Okay, well, that's so let me ask you another question. Thank you for the clarification on this. What about, like, let's say, like, you talked about the private equity. If you can just tell a little bit to our viewers, as like, what is private equity, how it works, and then at the same time, like, why, like, how's that different, like investing with you versus like these big hedge funds, big financial institutions?
Yeah, that's a loaded question. So, private equity has existed for a long, long time, and the traditional, when people think traditionally when they think of private equity, they think of a firm that goes out and buys companies. So they buy what's called a platform company, and then they find add-ons to that company, and they organically grow that group of companies. And then when they do that, the company is bigger, and when it's bigger, it usually trades at a higher multiple. So what they're able to do is take something, put it together, and the sum is greater than its parts, right? So when you put it together, it's worth a lot more. So that's what private equity has historically done with companies. It has historically been funded with institutional money, like all the really, the hedge funds and the retirement funds and the pension funds. They're the people that invest in all these private equity firms. Well, there was something called the Jobs Act of 2012. It was during the Obama administration, and the intent of that law was to say, wait a minute, this isn't fair. Why do only the people part of the old boys network get access to these really cool investments? So they passed that law and allowed regular everyday people to have the opportunity to invest in these private equity firms. So now we do the exact same thing that they do, but we do it with real estate. It's no different. We buy a piece of property, we put your money along with our own money, we make the property worth more, usually through increasing rents, and it stands to reason if we can generate more cash flow, just like the private equity firms do with their companies, the more cash flow you have, it stands to reason that somebody's going to be willing to pay you more for it. So that's how we make money. That's how private equity makes money. It's the same exact thing. We're just buying and selling apartment buildings. They're buying and selling companies. Now, people really, this is really, since that Jobs Act, that was 2012. So what, we're 11 years into this now, 12 years into this. And it's really becoming a lot more mainstream, because before these rules, the only way you could really get into real estate deals is either be really rich and know somebody really rich that lets you in and nobody else even finds out about the deals, or you could invest in like something called a publicly traded REIT. Well, as soon as you go to the publicly traded REITs, there's so many layers of management and costs and expenses that your returns aren't nearly what they could be if you could have gotten that deal, right? that deal as part of that old boy network, right? We'll call it that. So now that's what's happening. People are realizing that they have access to investments like these that can generate far greater the returns than they would if they were to just buy a REIT in the stock market or something like that. So what we do is no different than that. Now, there's two forms that we do it, and I don't want to get too deep here, but I want people to understand there's something called a syndication and there's something called a fund. The private equity model is truly a fund model, right? Where you go out and raise the money and then go find the deal, right? That's what we do. And we do that because it's a far better position to be in when you're a buyer if you've already raised the money. But people starting out, when they raise money, they start out as syndicators. So what they do is typically go find the deal and then go and raise the money to do that deal, right? So there's two different ways to do this business. One's called syndication, is called a private equity fund. Just want to make that distinction. There's nothing wrong with either one. We have just chosen to go the fund model because, we buy in competitive markets. And when there's 10 people trying to buy a property, and here we are, Mr. Broker, we've already raised the money. You don't have to worry about us. We tend to get the deal, right? We have a huge advantage. So that's kind of the backstory on how it happened, why we're here talking about it, why you're able to invest in these funds, why you even know about them. It's all started with that Jobs Act of 2012.
Wow, yeah, that's fantastic. Thank you. And actually, it's very interesting that you mentioned like how the private equity and financial institutions work, because when I started my investment journey and I was looking to invest, and listen, I didn't have millions of millions, but I had some money and I wanted to invest, and I wanted to invest somewhere besides just investing in the stocks and the mutual funds. And then when I was searching and acquiring these big private equity funds, like the known equity funds, like you cannot just access them. Like to access them, like you have to have like certain amount of money and equity,
Yeah.
and I'm not yet at that level. So, and I remember like that kind of the challenge that I was facing myself, and I'm pretty sure that a lot of regular people face this challenge as well. And those that do want to invest and they don't have millions and millions just to put down, but they have certain amount. Like what is it like? Is there like a minimum? Like if that minimum, like what is that minimum like typically for this type of private funds?
Yeah, so the standard minimum for our funds is 100,000. We've let people in for less because I want them to be comfortable, especially for the first time investing with us. But generally, it's 100,000. Our average investment is probably somewhere between 2 and 250. I haven't looked at the most recent fund that we just closed, but it's usually somewhere between 200 and 250,000. But yeah, it's far short of the $3, $4, $5 million that you're describing. So now it gives more regular people the ability to invest in these deals that can be really lucrative. The other thing that most people don't do, think about where's most people's wealth. It's in their IRAs.
Exactly.
You can actually create a self-directed IRA and invest in these funds. And as long as you got to use a special IRA custodian. It's not hard. We do it all the time. About a third of our investors do it. But I mean, if you think about it, your IRA, your retirement money is designed to be there a long time, right? It's not, you don't trade it usually. Well, real estate is generally a long-term investment. I love it when people put IRAs in real estate because it matches. That investment term is a good match, right? You don't have one short, one long-term. They're both relatively long-term, and it really works out well for the investor. So a lot of people don't realize that you can do that with your IRA, where most people's wealth is.
Exactly. Yeah, and that's exactly what I did for myself. I started doing self-directed IRA like a while ago. Well, being in the field of working with the taxes and money, I said, okay, I gotta take control of my own money. I'm not allowing anyone to play with it, and I started doing self-directed IRA myself. But typically, what I was used to do before is I used to invest in the stock market, mutual funds, and like I mentioned before, I was looking to diversify. And when I found out that you can actually use your pension money to buy real estate, that was like completely game changer for me.
It is for most people when they figure it out. Yeah, you're exactly right.
Yeah. So yeah. So now talking about now that I was sharing my story about like how I was looking about the diversification. So, what is your opinion on diversification? Are you, what are you? Is it just the real estate, or is there other um, investment platforms like their stocks? So like, what is your view on the different?
Yeah.
Yeah.
Yeah, I'm not a huge fan of the stock market. I know there's a lot of people probably going to listen to this program and this podcast who are very good with the stock market. Maybe they're traders, maybe they understand it better than I do. What I have never liked about the stock market, and it really seems like it's more true now than ever, you'll be in a big name company and all of a sudden you'll find some headline will come out like somebody had an affair with somebody or something ridiculous, and next thing you know the stock went down 30% or 40%. Like that's just I hate that unpredictability because I mean how do you know? I mean, how do you predict that? How do you predict those kind of headlines? So it seems like the volatility of the stock market just churns my stomach. Our investments, I mean, we've never lost a dime of investor money, but I think people lose money in the stock market every single day. And they've almost become, well, sometimes I win, sometimes I lose. And oh my goodness, if I approached our real estate world that way, that would be horrible. I couldn't imagine it. So no, to answer your question, I'm not very diversified. I really, I like to invest in myself. I like to invest in things that generate cash flow that, I mean, these are apartments. People need a place to live. I don't see that going away. It's not like it's office space. It's not retail. It's not storage. It's not, see, I can make a case for any of those asset classes to maybe have declines in demand, but people need a place to live. I don't see that going away. And as long as you invest in markets where there's population growth, demand supply. It's a basic economic equation here. As long as you do that, it seems like you should be in a pretty good position to make money. And then when you implement our value add business plan, like we don't buy an asset hoping that rents will go up. When we buy a property, we know what we're going to do. We know how much we think will move rents. So that gives us more predictability and more certainty, right? Nothing's for sure ever in this world. I mean, you can lose money in real estate, but what I try to do and have done over the years, this is the CPA in me coming out, I try to mitigate every single risk that I can find. Because if I can really control that downside, the upside really is gonna be good. Because it's those, like in the stock market, it's those 30% declines that kill you, right? It takes
Yeah.
5 years to climb out of
Yeah.
that kind of stuff.
Yeah.
So yeah, I'm not very diversified. I'm not gonna pretend to give anybody financial advice on whether they should be diversified or not. That's not my place. I can just tell you that I'm not very diversified and I'm happy to be in real estate.
Yeah, well, thank you so much for sharing your view on that. Yeah, and I actually love how you mentioned that is, being in control is because, yes, absolutely, with stock market, you never know what's going to happen. I personally do diversify, but I guess probably maybe it's just because I started, the first thing that I started with is with the stocks. I didn't know the real estate until later on. And from my own experience, there's ups and downs. Like you make money and then you lose money, and then you make and you lose. And just like you mentioned, like it's unpredictable. You never know if there's some kind of
Yeah.
news comes out or there's something happens. Versus like you mentioned with the real estate, and which I found actually recently, this is more predictable. And another thing that I really love about the real estate, and this is why I'm like so much involved in this, is I like that it gives you that cash flow. And just like you mentioned, like, having that cash flow, because in the stock market, you don't have that. You invest the money, you freeze the money, and that's it. You cannot touch them. I mean, like, like for you to make these earnings, you actually physically need to sell the stock then to take the profits, and then that's it. You're left with nothing.
Right.
But what I love in the real estate is that you get your cash flow profits every quarter, and then you get to use them, and then you still own the real estate.
Yeah, I love the fact that I have an assets, plural, that generates cash flow. And it just stands to reason that people who like cash
Yeah.
flow, right? They're going to be willing to pay something for that cash flow. So my job is to hyper focus on moving cash flow, make it better, increase it, because then somebody should be able to pay me more. So we're getting one of our wealth management clients. They do something really interesting. They put their clients in our fund, and instead of a bond allocation. Now think about this. This is really interesting because bonds, if you hold them to maturity, they're gonna mature at par, right? But if you've got real estate, you're getting this little drip, these cash flows, right, every quarter or however they're paid. But then at the end, right, after 10 years, there's a really good chance, not a guarantee, but a really good chance that real estate is going to be worth more than what it was when it was bought.
Yeah.
So now you're getting cash flow on an appreciating asset rather than bonds. Maybe they'll appreciate, depends on the price fluctuation, right? Depends on interest rates and whatever. But if you hold that bond in maturity, it's not gonna double in value. I mean, it's just not gonna happen.
Yes.
So I found that interesting. I learned that a few years ago from that wealth management firm, and I think it's just a brilliant idea. And so far it's worked really well for them. So I just thought I'd share that with you.
Yeah. Thank you so much for sharing. Yeah. And then here's another thing which I absolutely love to, and if you can share your view on that, is with the real estate, I really love how you have a choice. First is this deductions. So if you're not investing your money with the pension fund, with the self-directed IRA, if you invest your personal money, then you get the depreciation deduction, and especially if you use cost segregation. So that's another game changer, because you can literally make cash, you can make income, and then not even pay any taxes with that, because with all this the depreciation deductions that you're offsetting it with.
Mm-hmm. Yeah, that's a benefit we didn't even talk about, right? The deferral of the tax is huge in real estate. You got it. So even though the property's making money, we get to give you a K1 that has a loss on it.
Yeah.
And you got money out of that business. So yeah, that's hopefully the tax benefits continue, but they're huge. I look at the economics before I look at the tax benefits, because if the thing works economically, right, just looking at cash flow,
Yeah.
well, the tax is just icing on the cake then, right? But it's a big icing. I
It's a
agree.
big,
It is big icing.
yeah, it's a big icing on the cake, yeah. And
It is.
that's kind of how I look at when I talk with my clients. It's like, besides making this cash flow, also if you calculate the tax savings on the depreciation, then you're like doubling or tripling your return on investment. Yeah. So that,
Yeah, it's crazy. Yeah, you're right.
yeah.
I know, but people, you've alluded to this a few times. There's a lot of people out there that don't believe this is real. This is the reason wealthy people invest in real estate. You'd name me one wealthy person who has no money in real estate. You're going to be hard pressed to find a wealthy person who doesn't invest in real estate for the very reasons we just described.
Yeah. So then let me ask you another thing. Talking about investing in real estate. So there's a different ways of how you can actually invest in real estate. And you did mention like with this big you mentioned your doing through your private equity fund. So basically there's like syndications through the fund. Also you mentioned that like big institution, they're doing through the REIT. And also there is a most common way is just buying a house, renting it out, buying an apartment, buying a commercial building. I mean, I used to do personally myself all of that until I met Grant. And then like he completely opened up my mind to new world, because for me personally, what I actually learned is from getting to know him is that instead of actually having this cash flow, I was actually always in negative. I was losing money. I was putting money more and more to fix the properties or to pay for the mortgage because the tenants didn't pay, and like all the problems that were going on. So if you can, we can talk a little bit more about like what's your view on that? Like what is the difference? Because majority of the people, they so used of controlling that one apartment, one house, like being in control versus being part of the funds like you're talking about.
It's interesting that you bring that up, because you're right. Everybody thinks, well, I'm a passive investor. I invest in real estate. I bought a duplex. Well, you can attest to the fact that if you own a duplex, you're not passive. You're there fixing it, painting it, doing all, managing the residents, leasing one or the other side. So I actually had this decision to make for myself 26 years ago, or 28, whatever it was, a long time ago. But here's how I rationalized, and here's how I thought through the process. One to four families, they stressed me out because they were really small. And let's say I eked out $100 a month for a couple of years, and then I had to do a roof. Well, there went all my money. It's gone.
Yeah.
Like everything I thought I made, I better not have spent because I
Yeah.
needed it to fix the roof. That's the first thing that bothered me. The second thing that bothered me about that was I couldn't afford to have somebody else do the work that, and I was already a CPA, remember, working 80 hours a week. I had a young family. Like, there's no way I could stack more stuff on top. There's only so much time in a day. So that stressed me out. That I couldn't do that. And the third thing I couldn't get comfortable with is I couldn't, the way those one to four families are valued, they're not valued based on their ability to produce income. They're valued based on what the houses next door sold for, down the street. So now you have this disconnect between valuation and the asset's ability to generate income. There is no connection in single family homes because somebody may buy that single family home to live in it without any, that's a personal purchase, not a business purchase. Now look at the apartments. And then I went to the other extreme. I said, okay, can I buy 150 units? Well, at the time, no, that didn't make sense. I didn't know what I was doing. I didn't have enough money, no experience. Like, nah, that didn't make sense either. I just couldn't imagine putting that together. So I landed on these 20, 25, 30 unit properties because I felt like I could run them like a business. So I had this wonderful lady in my first building, and she actually helped me at all three buildings. She didn't even have a driver's license. She's an older lady. She had no reason to drive. She was wonderful. She loved, socializing with people. I gave her a free apartment and some money on top of that. She took care of the leasing, some of the light bulbs, picking up the litter, all that kind of stuff. So now I had a property that was valued based on its ability to generate cash flow, and I could treat it like a business because I couldn't go there. I was out of time, man. I was maxed out at capacity.
Yeah.
So that's how I landed with that. See, that worked for me.
Yeah.
Now, somebody like yourself, maybe you're really busy, you would make the decision, well, while I'm learning, and I think this is what you're doing, you're going to passively invest. So you're accomplishing that passive investment goal while you're learning, right?
Yes.
So but you've already been through the small property process. You already know what it's like. You know it's not a passive
It's
investment.
not. I know. It's absolutely
What
not.
it takes out.
At some point, I got so tired, me and my husband, because, we were, like you mentioned, like, we cannot afford to hire a management company. We cannot afford to pay someone to do the repairs. And then what we used to do is my husband, luckily, he is a very good handyman. So he used to fix everything, fix the toilets, fix the leaks, like literally fix everything. And I even remember we had a commercial property in New York, and when it would snow, I remember me personally, I had to go and shovel the snow.
Yep. Yeah, no, you're right. You're
Yeah.
right. So that's how I landed. That's why I like multifamily. So if you do the math, here's the crazy thing about multifamily. That predictability between when you generate more cash flow, the value should go up, right? There's a lot of other factors that go into that calculation. You know that. But if you think about it, if you take a 100-unit property and you increase rents $100, think about how much money. The way the math works, 100 units times $100 is 10,000 a month. That turns into $120,000 a year. And when you divide that by a cap rate, right? That's how we value real estate. Let me see what that is. I don't remember. Divided by, let's say it's a 6 cap. Because I raise rents $100 a month on those 100 units, that property should be worth about $2 million more than what it was before. Like, that's real money. Like, that's enough to get your attention, right? You own that property for 3 or 4 years. It's not hard to move rents $100, especially if you're in a strong market.
Yeah.
And to then profit like that, right? What was your investment? Maybe you put 3 million or 4 million down. That's a 50% return. Plus you got paid. What if you do it $200? What if you do $300? You see, we won't even look at a deal unless we have 200 to 300 in upside.
Yeah.
Because we know that we want to make a lot of money. So if you do 100 units times $200, your profit becomes 4 million. Well, if you put 4 million down, you just doubled your money, and all you do was raise rents. Right? Think about that. That's why this business works so well, and that's why I'm doing what I'm doing, because you can make insane amounts of money for yourself and your investors. Now, it's not without risk, right? It does have potentially have risk. You got to make sure you invest with somebody that knows what they're doing. But that's the holy grail, right? That's why people do real estate.
Yeah. Wow, that's amazing. That's amazing. And I actually you mentioned about raising the rents. What I experienced myself and when I had my rental properties is when you buy like these units, apartments, duplexes, and you have the tenants, you can't even raise rent to them. So like like when you actually have the apartment complex and you have 100 tenants, as you mentioned, like you have a whole lease, and then okay, it's already assumable. And we even like I used to rent myself, so like as a rental you already know that every year your rent is going to go up. But then what I found is that like when you rent one-on-one just to someone on a private basis, like they like you can't even raise the rent. So basically if you start having a tenant paying you 2,000, they pay you this 2,000 for like another probably 10-15 years because you're so scared to raise the rent. Because what if they're going to leave tomorrow? If they're going to leave tomorrow, then you have no money coming in. So that's just kind of what I wanted to share because, yeah, that's what I found happening.
Ellie, you just hit that right on the head. You said that. I think that's interesting the way you phrased that. You said you're scared to raise the rent because if they leave, you went from 2,000 to zero. And guess what you still have? Now you've got to turn. You got to turn the unit, turn the house or whatever, and you've got to re-rent it. And now you got no money coming in because you have a mortgage and everything else. So that's the key there. You're scared to raise rent.
Yeah.
We see that a lot.
Yeah, yeah.
In the multifamily world, you're kind of not. You're not scared because of one, if you raise rents $100, maybe one of the two people leaves. Okay, I can still live with that.
Yeah.
Right?
Yeah.
I can't.
Yeah.
And it's going to be over a 12-month period.
Yeah.
So it doesn't destroy your cash flow.
Yeah, exactly. Yeah. But then, and at the same time, I think it's a little bit even different because when you renting in the big apartment complex, it's, like it's already expected. There's the rules. It's an organization. There's management.
Yeah.
You don't talk to the owner. Versus me renting it one-on-one, when they actually, I am the owner, and then guess what they're gonna go do? They're gonna come, they're gonna cry, and that's what my tenants used to do. They would cry, and I would feel sorry for them. Yeah.
That's exactly what happens. Yeah, you're right.
Yeah.
That's the reality of real estate.
Yeah,
you're right.
yeah. You mentioned something about the risk. So I wanted to talk a little bit more about that. So a lot again, I hear this a lot from my friends, my clients, coworkers. Like about like the risk of investing in these big apartment complexes. So we can talk a little bit more about it. Like you did mention about like the like how you do the underwriting. So what are the things? So like let's say if someone new comes in and they want to invest, like what are the things that they need to pay attention? Is there something that they need to know? Like how do they find out what is that right syndicator or right fund, that right company that they can trust and invest with?
Yeah, so that is more important question than you probably realize, because when you buy in the stock market, right, you probably have a stockbroker or somebody, and there's analysts following the stock, and there's a lot of publicly available information. But let's say you want to invest with us. We don't have, we have a website, okay, we have information available, we have a track record, but we don't have analysts that follow us and do write-ups on us and things like that. So now you've got this whole new problem that investors face is, who should I invest with? Should I invest with KRI, ABC, XYZ? Who should it be? So I've developed 4 rules that I want people to follow. And whenever I look at an investment with a syndicator or a fund manager that didn't go well, I usually see the investor broke one of these 4 rules. Number 1, you got to invest with somebody with experience. That seems obvious, but the reason is more important. Think about COVID. We didn't know. Who would have thought COVID was be a thing? No way did you predict that. Then what about the hyperinflation? How would you predict any of these things? It's important that you have a senior management team managing that business. Remember, it's just an apartment building. It's still a business that has been around a while. It can figure out how to navigate whatever's coming next because we don't know. So that's what experience is important for. Number 2, You want them to have a track record. So some people say, well, Ken, isn't that the same thing? But it's really not, because what you want is a track record of people that have turned deals. We call it full cycle. They bought the property, they did their thing, they implemented their business plan, they sold it, they made money, and the investors, you can see what the investors made. We've done that 13 times. See, that turn, that we call it full cycle deals, I think is really, really important, because that's a track record. You can say, okay, I've seen these people have done this over and over and over. Gives you more comfort that they can maybe do it again. Then the next thing is you want them to be transparent. So many times people are not transparent. If you go to our website at kripartners.com, you'll see our track record that was vetted by a company called Verivest. So we paid them a lot of money, like way too much money, but they came in and they audited our full 25 years of deals. I had to send them settlement statements, tax returns, all that kind of stuff. Because I wanted, as you're considering investing with us, I want you to see what our track record is, but not just, hey, take my word for it, Scout's honor, okay, we did well. No, I can't do that. We hired someone else to come in and look at, so that you know somebody's looked under the hood here at all of these deals, right? That's transparency. And then when you're an investor, you know, because you get quarterly reports, you get the financials, you get the rent roll, you get everything. You know what's going on. And if you have questions, you can call us. And then the last thing I want you to do, the last rule, is make sure that they put investors first. So that's harder, because that means you got to read the terms of the fund, and because there's, they're all over the map. But what you have to ask yourself is it possible for that fund sponsor or that fund manager to do really, really well and you not? If the answer is yes, they're not putting you first. So what I found, if investors follow those 4 rules, they're really setting themselves up to have a good relationship. There's no guarantees in anything, right?
Yeah.
There's always somebody's, you're not going to bat 1,000. Even Warren Buffett doesn't bat 1,000, right? But you're putting yourself in a good position, rather than when I see relationships that don't go well, they've broken at least 1 or 2 of those rules. So those rules I think are important, and they will go a long way to help passive investors figure out who they should be with.
Oh, I love that. I absolutely love that. And that's why now I have you as my mentor as well. I wish I would have known you like 5 years ago, because I did invested in one deal. I didn't know these rules 5 years ago. And, unfortunately that deal didn't go very well, but now that I do, so thank you so much for sharing with our viewers. I think it's very important, because everyone is working so hard to earn this money, and the last thing that anyone wants to do is lose the money. Well, we can go on and on about this. I mean, I'm very passionate about the subject, and you as well. I do have, before we wrap up, I do have 2 more questions that I wanted to talk about. So I wanted to talk about a little bit, like, if you can share your perspective of what's going on right now in the real estate world, and then especially like with the interest rate, and then like with the market itself. There's controversial discussions about what's going to happen next. So I would like to know what are your thoughts on this?
Yeah, so first of all, you can't ask me to tell you what I think the stock market's going to do, because I have no clue what that's going to do.
I'm talking about real estate.
Yeah, okay, good. In terms of real estate, and let's talk about multifamily, because every asset class is a little different. There's a reason that after 25 years, I still only do multifamily. It's because I can't find a better risk profile, right? Like if I can earn 15, 20, 25% annual returns for our investors on a relatively low risk asset, like what more do you need? Let's do that, right? So people are going to need a place to live. When they think about what's happening in the real estate market right now, there's not a lot of transactions, so not a lot of properties being traded, and it's because interest went up so much so fast. And what happened was there are a lot of people out there who, they might have bought at a 4 cap, right? It's because interest rates were 4%. But now you can't get a loan at 4%. So a buyer can't pay as much, because their loan's going to be at 6 or 6.5%. So they can't pay as much. Well, you have a lot of people out there who, when they bought, maybe in 2021, early 22, and didn't move rents very much, their property actually isn't worth as much as when they bought it. Well, they're not going to sell it unless they absolutely have to. So you've got a whole group of people who are just waiting for rents to go up, and that's usually what happens in real estate. If things get tough, as long as you don't lose your property, you can usually wait this out, right? Because rents are going to continue to go up year after year just due to nothing else than inflation. And if rates stabilize and maybe even come down a little, that really gives them some relief so they can sell the property. There are buyers right now. We're out trying to buy. Our challenge is finding sellers because if you don't have to sell right now, you probably aren't. It's the people that have to. So now who is selling? The people that I just described. Maybe they're on a variable rate loan and they may have bought some sort of rate protection like what's called a rate cap that capped their rates out, but that rate cap is expiring and the underlying loan variable rate went way up. Well, now the property doesn't generate enough income. And so they either have to buy a new rate cap, which can be expensive, or they have to pay down the loan because the cap rates went up on them. So those people, if they can't do that, they're selling, right? So there's a lot of not distressed properties out there, they're distressed sellers. That's important because they're good properties, the seller over leveraged them. And remember what I said, as long as you don't lose your property, you can usually wait out any challenge in multifamily. Well, a lot of those people put variable rate products in place. I'm just not brave enough to do that because I've been through '08, '09. I've seen the credit markets dry up. So right now we have this little impasse, right? It's called an expectation gap. Sellers want to sell at prices that buyers can't afford to pay yet because they can't get the loans. That'll come together. Some of the buyers or sellers will capitulate because they have to, and rates will come down over time, right? The longer they hold rates, the more opportunities there'll be for buyers like us, because the longer rates stay high, that means those guys can't refinance at numbers that they need to, so they'll have to sell their property to guys like us. So that's the real estate market. In terms of interest rates, I don't know. Every time the Federal Reserve makes a comment, the rates just go crazy. So I don't have any prediction there other than to think, if you think longer term, I think rates will they're not going back to where they were. I would guess that if you're looking at a 10-year right now of about 4.25, it's probably going to settle out in the mid threes over a longer period of time. That's just my guess, but that's just one man's opinion. But that seems like where it should be. That's kind of restrictive right now, right, on purpose. And I think if they back off of that a little bit, that'll put them down 75 basis points from where they are now, and that'll be reasonable. Those are my predictions.
Yeah, okay. I actually remember with the real estate, you mentioned real estate rates. I remember when I purchased my first house in 2001. That was a private property, so the real estate rate was like about 8%. So you said they should be where they should be where they are right now, because like we got so used to being them so low. So so having this interest rate at that level as they are right now, and everyone is saying like it's too high, but like for the multifamily, it's actually, as you mentioned, it's for our advantage, right? Because then we can.
If you're a buyer.
If you buy, yeah.
Because you buy at a lower price.
With a lower
yes.
price, yeah.
Yeah. What's most important in my world is interest rate stability. It's really hard to go under contract for a property and have rates move 75 basis points.
Yeah.
Like that's hard. I mean, that's a massive impact on your loan payment. And that's what makes buying right now a challenge. On the buy side, other than sellers being reluctant to sell, buyers are taking on that rate risk because it's not like a single family home where the day you apply, you lock in your rate. You can't do that. It floats around out there while they're doing all their underwriting, you're getting your third-party reports.
Yeah.
And if they move against you, they move against you. It's just a challenging position to be in. The only way to eliminate that is to pay cash, and most people don't pay cash.
Yeah. So, and you mentioned about the crisis in 2008, 2009. So, what are you thinking like now towards where we're going? Everyone is talking about this real estate correction. Is it actually going to happen? Because like from what I see right now, the prices didn't drop yet. And like, what are you thinking? Like, what are you thinking? Like your expectations would be like, what do you think?
Yeah, I'm not, first of all, I'm generally not an extremist. 08, 09, what happened then is not happening now. And it's mostly because back then the banks drank the Kool-Aid. The banks were the problem. The banks aren't drinking the Kool-Aid now. The banks are saying, I'm going to lend what this property can afford, and that's it. End of story. Not anymore. And they didn't do that back then. So that created a lot of problems. Now I would say I would say that is probably, as I think through the issues, the fact that banks are now holding the line and that you can pay whatever you want, just they're not gonna drink that Kool-Aid. So you do whatever you want, they're just gonna hold the line. That's gonna keep things in check, and it has kept things in check. So the only correction we're gonna have is these people with these variable rate loans. And although it's a big part of the market, a lot of this stuff will trade. When I say correction, I'm thinking a small correction, right? Because they're going to meet in the middle. The bank's going to not let it come back to be a bank-owned asset. Because as soon as it does, then it loses tons of value. So it'll be a minor correction. It's happening now, but if people can hold off and not sell, they just won't. And the relief will come when the Fed lowers interest rates some. That will ease that correction.
Yeah.
So the longer they keep rates high, the bigger the correction. That's the way to think about this. If they drop rates some, they will ease that correction amount. It will be less of a factor. But I still, in my business, whether you bought in 21, 22, 23, 24, doesn't matter. If you follow the discipline and underwrite the correct way, you've heard me say this a million times, the underwriting is what it is. You don't pay more than what the asset can generate, and you have to be able to pay your loan and have some for your investors. I mean, it is literally that simple. And if you follow that rule, you'll generally be okay. And in our world, we just want the extra thing, and that's the upside. And we do the research to try to see if it's there. And if it's there, then we think we're going to be in good shape. So it doesn't matter when you buy, just follow that rule, and don't buy with upside of like $20 or $30, right? That's not enough to shield you against something. You need $200 to $300. That's why we go for that.
Yeah, and then and you're still gonna make money no matter when you buy, if you follow the rules.
You will.
Awesome.
That's
Well,
right.
amazing. So I guess, like I said, we can go on and on. I want to be respectful of your time. I know you're very busy, and I appreciate you taking your time. So before we're going to wrap this off, is anything else you would like to share with our viewers? Please do so.
Yeah, so I don't know exactly when this will air. We did just close out our last fund. We're in the process of ramping up our next fund, right? We're always have a fund. But I would just encourage anybody to check out our website, kripartners.com. If you're thinking about passively investing, we can help you. If you're thinking about trying to figure this business out, we can help you. Either way, but yeah, kripartners.com is the only thing I would ask. Check us out if you're interested, and if not, no worries. Hopefully, by going to the site, you've learned a little bit more about real estate.
Yeah. Okay. Awesome. And then you can share the link for me, and then I'm gonna share with the viewers as well.
Oh, thank you.
Yep.
Thank you
Yeah.
very much.
Well, thank you so much, Ken, for sharing your wealth of knowledge and insights with us today. It's been unbelievable. It's been a pleasure to have you here. And thank you to our listeners. Stay tuned for more enriching conversations about making money.
Thanks so much, Ella. Have a good
Thank you so much, Ken. Thank you.